So we'll continue on with our discussion on insurance. So as I sort of started telling you about, insurance companies work in this idea of risk pooling. So that's the intuition behind how insurance companies make things work. The idea is that you insure a lot of people and then hope that not a whole lot of people claim losses or have losses all at the same time. So that's how the whole goal. As long as there's more money coming in than going out, insurance companies do real well. And that's the goal here. And that's why you'll notice that when major calamities happen, such as the New Orleans disaster and so on, that's when a lot of insurance companies go out of business because they are not really designed to handle those kind of shocks. Financial shocks. It's only the largest companies that can withstand those kind of shocks, insurance companies. So that's sort of the, so in general, as long as there is a decent amount of withdrawal of money through claims, but there's more money coming in through their, premiums and so on, insurance companies work well. So when we think of life insurance, well, it's really these are the various types of life insurance that exist. So you have term, whole, universal, variable, and then variable universal. So those are the ones we'll discuss. These are the major types of life insurance. Term insurance being the most fundamental and the oldest of insurance policies. That's term insurance. And then we'll go from there clockwise. So term insurance is the simplest, the oldest, goes back thousands of years, even though it was not called term insurance in those days, but it's basically the same idea. The idea was that people would come together, pool money in a pot, and then have an agreement, a mutual agreement, that if one of them died, or whoever many died in that group, their survivors, wives and families and so on, would get money from that pot. So that was sort of how insurance started, and that's the oldest example of term insurance. And the modern day term insurance really works the same way. You buy a term policy, and then if nothing happens to you over that period, nothing happens, nobody gets paid. The insurance company gets paid, of course, to carry the risk, but other than that, nothing changes. So if something were to happen to you during the lifetime of the policy, then your chosen beneficiary gets the predetermined amount in payoffs. Term insurance is also the cheapest. It is the cheapest, and it's the one that young people can afford the most when they start off. It is pure death insurance, as it's called. There's no frills, nothing. You pay for it, pay for coverage. If something happens to you, your survivors get money. Otherwise, nothing happens. No money changes hands. The problem with term insurance is that it gets expensive as you get older. And that's the problem. The problem is that when you're young, when the likelihood of death is arguably the smallest, that's when it's the cheapest. So it's really affordable when you need it the least. And it's highly unaffordable when you need it more. And that's the problem. That was a problem, and that is a problem, and that's the reason why insurance policy planners decided that they needed something else. Otherwise, it was just not working, because we don't need insurance in that sense urgently when we are in our 20s, 30s, and so on, but we do need it when we are in our 50s and 60s for sure. And the problem was, by the time you got there, term insurance was just too expensive to afford. And so how do you take care of that problem? And so what came next was this modification on term life, and it's called whole life insurance, which became the workhorse of the insurance industry. And the way it worked was the following. So the problem was that how do you keep insurance affordable through the life of a person? How do you keep the insurance premiums affordable so that people will actually buy this thing? And the way they did it was kind of ingenious. What they decided to do was that initially when you're young, you bought this policy, you would overpay. Your premiums would be more than what would be for a corresponding term insurance policy for the same face value. So your premiums would be greater initially when you are younger. And that difference between what was appropriate for your age and the overpayment that you're making would go into a savings component. And this is what is called a cash value buildup. And so you would have this overpayment of premium in the early years of the policy accumulate in a savings account in your name called, and it would develop into what is called a cash value balance in your account. It would develop, so you would generate money in there. And then as time went on and your personal risk increased as you got older, then the money from that built-up savings component would be used to pay for part of your premium, so that effectively your premiums would not change. Your premiums would remain flat throughout the policy period, the entire life. And the reason why that could be done was because you had a cash value buildup in your policy over time, which would kick in and pay for part of the premiums that you were paying. And therefore, and they were designed in a way that the premiums that you were paying over time would not increase. And that's how they sort of solved some of the problems. There was still confusion, but there's still some problems with life insurance policies that we'll see. But that was a major breakthrough, because that made insurance policies affordable, more importantly, affordable for older people. And that was the main feature of this thing is that your premiums will remain constant throughout the life of the policy, won't change, but you will get coverage. The difference being that there would be a savings component in your account, which will then take care of the increase in premiums that would be normally coming to you, but now would be taken care of from the cash value buildup. And so that's how the insurance company got around that problem. And this cash value is yours. So if at some point you decide to cancel the policy, the cash value comes back to you in a check. Okay? So the way, and I'll show you in a graph how the mechanics works of this whole life policy. But the idea is that the insurance contracts in this country are designed for between 0 and 100 years of age. After 100, there's conventional policies are not designed to go beyond 100 years of chronological age. And so if you're buying a policy somewhere between that age, which is what we all are doing, then you are funding for part of the death benefit yourself. How does that work? So for example, you buy a policy of $1 million, right, face value, and you're 20 years old. So let's say you pay your premiums and you continue on, and let's say at 30 something happens to you and that person, and the person, dies. And then what happens is the insurance company will still have to pay the $1 million to the survivor of this person. But some of that $1 million would come from the person's own cash value buildup. And then the insurance company would pay for the rest from their own funds to make up the $1 million. So here is, well, I'll answer this question. We'll try to answer this question in a second. Let's try to use this for once in the semester. All right, let's see. Where is the switch? Open.
Yeah, it's right here.
Ah, that helps. Okay. Well. Okie dokie. So years, dollars. All right. So, okay. Whoa. Okay, so that's how far I've gotten so far. All right, so let's say this, we start from here, 20, and we'll call this 100. So let's say you buy a whole life policy for $1 million. We'll call this here 1 million at this point. So this is the dollar axis, this is the years on the horizontal axis. And so let's say we buy this $1 million policy, which means that anything happens to you between 20 and 100, your beneficiary gets $1 million straight up, no questions asked, and you're paying premiums and all that stuff. What happens is that there's a cash value buildup. So what will happen is that there is a cash value buildup, so that so at 30, let's say we'll call this at 30. This is the buildup in the cash value. Then let's say this is 50, 75, and 100. So what happens is, let's say, so this person gets this policy at 20, at 50, he or she passes on. $1 million comes, is paid to the deceased, his or her chosen beneficiary, and out of that 1 million, this comes from that person's own cash value buildup. The rest is contributed by the insurance company to make up the $1 million. So you can see that at 75, the million, so a lot of the million is coming from that person's own savings account, the cash value buildup. This is the difference. This is the amount that's paid by the insurance company to make up the million, and so on. And until at 100, the cash value buildup equals the face value. And therefore, at 100, it doesn't cost the insurance company really anything, because the person himself or herself funded her own policy. So this is how this thing works. This is how the cash value idea works in insurance contracts and whole life contracts, is that this is the cash value buildup line. And that it's designed to be such that the buildup, the cash value buildup, equals the face value of the policy at 100 years of age. So what does that mean then? So how do we interpret this? So let's get the screen. So the question here is the one we asked. So having seen that, now what do you think the answer should be? And why?
Generally saying they want you to live longer so you can pay more into it.
Right. So economically, it makes no sense for insurance companies if the policyholder passes on quickly. It's actually a loss. For insurance companies, they'd much rather the policyholder live as long as possible, because that way the person can fund their own death benefit. And that's the whole idea. So insurance companies want you to live as long as possible, to 100. Everybody should live to 100. Now that might create its own problems, but that's a discussion for a different day. So from an economic standpoint, it behooves the insurance companies to have you live as long as possible, because of the financial thing, that they take the least hit the longer you live. Okay? Anything I should look at? Isn't term insurance risky in a sense because it obligates you to... it's no riskier than, I don't know, risky relative to what? That's the question. Insurance is... Look, you're buying insurance contracts to lay off risk, so it's not risky in that sense. I have to have you explain to me what you understand by the term risk, but the idea you buy insurance policies, whatever the type of the policy is, it's secondary here. The reason we buy insurance contracts, if you recall our first day's discussion, is to pass off risk. So in exchange for money, in lieu of money, we get the insurance company to pick up our risk. So if there's a risk of death in the life insurance situation, premature death, then the insurance company pays off our survivors. So that's how this thing works. Okay, so it's a risk. So in a way, when you buy insurance contracts, you are reducing, or you're trying to reduce risk, which is why you buy the policy to begin with. Otherwise, it's all on you. live longer because they can earn a lot more money. Yes, that I think says it nicely. Wouldn't living until 100 years old also cause somewhat of a liability? Liability to whom? Or what kind of liability are we talking about? This is strictly from an insurance contract purposes. Yes, living longer has its own problems, as we all know. But that's not this discussion here. Here we're just talking about it from a life insurance affordability standpoint. Yeah, why does my insurance company have set times when they ask me if I want to up my life insurance policy, and what are the pros and cons since I'm 2020? This is a great question, one I'd encourage you to hold off on, because we're going to talk about that. When do we need life insurance and under what circumstances? So we'll get to that in probably today. Where's my, oh, okay. So here's the graph which I drew, sort of simple thing here, which is the one I just drew on the board here, on the display thing here. So we've already explained it. And then these are the various types. So these are definitional, level term, and so on. Okay, now let's talk about the problem. So yes, so whole life solved one problem. And the problem being that with term insurance, which is the most fundamental of life insurance policies and the oldest, the problem was that as you got older, you sort of got yourself priced out of the market. It was just too expensive. So whole life solved that problem by making this cash value component and then using that to subsidize your premium payments as you got older. So that in effect you would have a level premium payments, but you would be covered into as long as you live, the rest of your life. But there were two problems still with life insurance, whole life policies. One is that it was like a black box, that you didn't really see how much of your premium was going into the cash value component, how much of it was going to pay off commission to the insurance agent that you bought this from, and so on. So you really didn't get a sense of how much money was going. In fact, life insurance policies are quite lucrative for insurance agents, and they'll tell you that they get a lot of commission in making these sales. So a lot of your money in the early stages of a life insurance policy, in fact, is rewarding the insurance agent, not as much as going to your cash value buildup. So that's a problem. And then it's inflexible. The second criticism against it was that it is inflexible. So once you set the terms, there is no changing it. So if your circumstances, because this is a long commitment. When you get a whole life policy, you're thinking 50, 60, 70 years of coverage. And there is nothing, it's extremely inflexible. There is no changing of the terms to reflect changing circumstances in your life, other than straight up canceling the policy, which has its problems. So that was an issue that was not very good with this kind of policy. So once again, we were ripe for some changes in how these life insurance contracts were done, and so enter universal life policy. So this was an improvement over whole life policies, and it was unbundled. So the major innovation of this policy was that it unbundled your premium payments so that you got to see exactly how much of your premium dollars were going into the cash value component, how much of it was going into commission, and so on and so forth. So so that was a big advantage. It made things a lot more transparent. And also the policies allowed the policyholder to do some adjustments to the premium. So you could pay less certain times in your life if you had less money coming in. And so the cash value buildup would be slower than normal, and so on, and death benefits would be adjusted accordingly. So it gave you a lot of flexibility, and which was definitely an improvement over the traditional whole life policies. But universal life was not without its critics either. And the major criticism of universal life was that it was too boring. It was too boring, in fact, because that the cash value part was invested mostly in fixed income or bond market security or bonds. And in the late 80s and early 90s, when the stock market was taking off, this became a problem because people thought that this was too slow, it's too invested in the bond market and not enough in the stock market, and that was a criticism. And so in order to address that, you had variable universal life, which then made it more like an investment policy. The cash value really started resembling more of a 401k plan that we'll start talking about pretty soon when we get to retirement. But that meant that it became more of an investment vehicle than really an insurance vehicle, and that was a problem too. A lot of people then started pointing out that if you want to invest, there are other clear-cut investment vehicles that you can put your money in. You don't have to use it through your insurance policy, because insurance policy at the end of the day is meant for security and stability and things like that. So this whole idea of making the cash value look more like a 401k plan was not something that was palatable to everybody. So that was another problem. So no matter what you do, there will always be somebody who would come up and say, well, it's a problem. So that's sort of, so you would, and if you talk to real insurance agents, they'll tell you that the universal life is probably the most common policy, life insurance policy that they sell, followed by whole life policies. But variable universal life is probably not up there anymore because people want the security of knowing how much their money is going to be or how much the cash value is going to be at certain points. And variable life makes it too uncertain because it's really dependent on the stock market, on your kind of investments that you invest in, and so on. And there's no guarantee what the cash value will end up being because, the uncertainties of the stock market. And so on balance now, universal life is probably the most popular life insurance vehicle out there. So the question that one of you asked here relates to this: do you really need life insurance? And if you do, when? And the simple answer is that if you were to pass on tomorrow, is there anybody who will be dependent on you financially? If the answer is no, then you don't really need life insurance at this point. You only need life insurance when you have dependents who depend on your income. So typical situation is you get married, you have children. That's a dependent situation where you do need life insurance, so that if something were to happen to you, then they would be cared for. And that's when you don't have financial dependence, you don't need life insurance. That's the simple answer. So to answer the question, one of you asked, well, I'm 20 years old and your insurance company is trying to get you to up your coverage. Well, when you increase the coverage, obviously you pay more in premiums. That means the insurance company earns more off of you. But the question is, do you really need it? And so that's a question you have to ask yourself, is that if you do have dependents, which is presumably why you have insurance to begin with, then what's the additional coverage going to be? Do you need to increase the coverage now or wait till later when you have a family and so on? Or if you have a family now, then you may consider increasing the coverage so you have to ask yourself those kind of questions as to how much money is needed, if something were to happen to you and so on, and then decide if the coverage that you have is enough to take care of your dependents. So here's a simple way to calculate life insurance needs. It's pretty, obviously a lot of assumptions go into it because none of us know exactly when our time is up on this earth. And so you have to make a lot of assumptions. And so you get a ballpark figure, rounded up nicely, generously, and so on. And then, more importantly, when you're shopping for insurance companies, not all insurance companies are created equal. So insurance companies, just like any regular financial companies and stuff that we've talked about so far, insurance companies are companies. They are profit-making entities. And just like regular companies, they also go through their bad companies and good companies. Good insurance companies and bad insurance companies. And just like other companies are rated and you get a sense by looking at their stock price and so on, you can get a sense of how financially viable your life insurance company is by looking at a certain companies that rate them. So there are life insurance rating agencies, company rating agencies that rate life insurance companies and for financial viability. And those are the kind of things you should check to make sure that the insurance company that you're thinking of getting a policy from have the financial wherewithal to be in the business in the next 20, 30 years, because that's what you want your insurance company. So it's always good to go with a more established company that's more likely to be around later in life. So another advantage for insurance and having a cash value insurance policy is that you can borrow from it. You can borrow from the cash value component, paying a little under market rates, borrowing rates. So you can actually borrow. The downside of borrowing from insurance is that it reduces the cash value of your policy. So if something were to happen to you while you've taken money out of the policy, your beneficiaries get less money because that amount that's out is going to be adjusted by the insurance company. So they're going to get less money. And if that's okay with you, then hey, go for it. How much can you borrow? You can pretty much borrow almost up to the full cash value. So this is a lot like having home equity. We've talked about this earlier. When you have a house, you own a house and you have equity in the house, then you can go to another bank and get what is called a home equity loan, or a second mortgage as they call it. Almost up to, some banks will restrict it to 80 or 90% of the home equity, but you can pretty much get up to that amount in an additional loan, a home equity loan. So it's the same thing with insurance, with a cash value. That's like equity. You have equity and you can borrow against that. Okay, so it's sort of similar. Although, when you do borrow against your insurance policy, you do not get the tax breaks that you would when you do a home equity loan. Home equity loan interest rates are tax deductible, just like your mortgage loans and so on. Here, of course, that's not the case. So interest is pretty competitive rate. And the question that people always ask is that why can't, it's my money that I'm borrowing, why do you have to pay interest at all? And the answer to that question is that it's not really your money that you're getting. So it's not like the insurance company is saying, okay, you have cash value build up, I'm just going to dip into your cash value and give you the money, i.e. you should not have to pay any interest because it's your money. It doesn't work that way. What the insurance company is doing is holding your money as a collateral and then loaning you money against that collateral. And therefore, it's not a free interest rate kind of thing. You still pay interest on your mortgage or on your loan, just like you pay interest on your mortgage loan, because you still have the collateral, the house that's written against it, but you still have to pay your interest rate on the loan. The same thing works for insurance when you borrow from your insurance policy as well. So that's why that. So here's a tax reason for not letting your policy lapse, because then the loan is treated as income and then goes and hits your, you have to pay taxes on it. Viatical insurance is something that became popular in the 80s when a lot of people were dying in wake of the AIDS epidemic. A lot of young people were getting this disease. Nobody knew how to treat it. And whatever treatment there was very expensive. And so a lot of these people, a lot of these patients had large life insurance policies, but they were no use to them because they needed money to live, to extend their lifestyle or lifespan, and they needed money to expand their lifespan. And then what would happen was that they didn't have money, but they had life insurance policies, and so you had this market develop where investors would buy off your life insurance policy at certain pennies to a dollar, say 60 cents to a dollar. So if you had a $1 million face value life insurance policy, for example, an investor would buy off the policy at, say, 60 cents to a dollar, give you $600,000 in cash for that policy, and then you'd have to make that person the beneficiary. And then the person would continue to pay the policy to keep it alive as long as you lived. and then after you died, then the person would cash in, get the $1 million. So that was the investment, right? So you pay $600,000 up front, or whatever. It doesn't have to be 60, it could be $500,000, whatever you negotiated with the holder, policy holder. And then that would be the upfront payment to the investor. And then however long you had to keep the policy going, as long as the person stayed alive. And you had to keep the policy ongoing, because the person, whoever you bought the policy from, would take the money from you and be out of the policy. They would just simply make the investor the beneficiary and then just be out of the policy. And therefore now the investor's responsibility was to keep that policy going financially, not let it lapse. And so you'd have to make the premium payments for as long as the initial policyholder lived. Then when the initial policyholder passed on, then the investor would become the owner of the policy and get that $1 million. So you do the math and figure out. So obviously the longer the person lived after contracting whatever disease, cancer or any other terminal disease, would cut into your returns, right, on the investor's returns, because you'd have to pay that much more to keep the policy on. So that's how this thing became a huge industry about 15, 20 years ago. Now it's not so popular anymore because, first of all, there are great drugs now that medication and cocktails and all that increase lives of HIV positive people for years and years. So it's not really big anymore of a major deal that it was even a decade ago. But it's still there. And there is an industry, and now a lot of insurance companies get into the act themselves. So if a policyholder, for example, in a particular insurance company were to need money for expensive medical treatment, whatever be the condition, the insurance companies have provision now to buy off the policy, similar to what outside people would do with viatical insurance. So viatical insurance is now handled in-house by most insurance companies. They do it themselves. So the question is viatical insurance really a good investment idea? And that's, the jury's out. I mean, it's not clear because, again, depending on the upfront investment and so on, it's not clear. Okay, can you overpay your premiums? I do believe you can overpay because a lot of times you can underpay. So there is the underpaying. So let's say with Universal Life, there is the provision that if you're laid off from work or any kind of financial difficulties, then you can pay less. There's a certain minimum that you have to pay, but you can pay less than your usual amount. So if that exists, then the other side has to exist. So you have to have parity in that. How do small insurance companies survive when people tend to want to work with and trust the larger? Small insurance companies survive in niche markets, in smaller markets where people know the company or it's a local company. A lot of times you get business that way. It's the same argument as to how do mom and pop stores survive when you have the Walmarts and the Costco's and stuff in the neighborhood. It's the same argument. How do mom and pop operations survive? Well, with difficulty, obviously, because most of them survive through personal relationships. You're a neighborhood store, you know people, you know families, and they come and give you business. It's the same idea with these small insurance companies as well. Relationships is what makes them survive. Not very well because, the Walmarts of the world or the insurance companies that resemble those large retailers also can work in ways to undercut business. Yes, absolutely. And so relationships matter. You'll see these small operations, whether they be stores or smaller insurance, local regional insurance carriers. They're regional banks. You can make the same argument. How do the regional banks survive? Banks like Purdue Federal Credit Union, that's a regional small bank. It's a minuscule bank compared to the Chase banks and all these other banks that you have around. Huntington, local bank, regional bank. Fifth Third. I mean, these are all small regional banks, but they survive. They do pretty well. It's because you capture a niche market in a small area. You develop relationships, you aggressively push your business, you provide certain services, which not of large banks will. They're more impersonal, if you will, because they had offices in New York or one of the big cities. They don't really know, whereas these neighborhood banks know you. That's how, if you see the ads, if you see the television ads of these local Huntington banks and all that, you'll see that's what they say. We are your neighborhood bank, we're there for you, and things like that. That's sort of the pitch. So it's the same thing with insurance companies too. It's the same idea. If insurance companies invest our premiums, couldn't we create our own insurance in theory? Absolutely. By putting absolutely. In fact, that's a great question. So the question is fully, if insurance companies invest our premiums, couldn't we create our own insurance in theory? By putting away money in stocks, bonds, and savings accounts regularly, the only missing piece would be immediate money when needed, right? So here's what you can do. In fact, a lot of people will say that. So if you are real disciplined and you understand markets, financial markets reasonably well, then what people do normally, a lot of people do, is that they buy term insurance and invest the difference. So if you buy term insurance, which is the bare minimum, cheapest insurance to get, right, and the lowest premium per dollar of insurance, then and if you know what the corresponding whole life policy premium would be, so instead of paying that money to the insurance company and all the premiums and all the commission, etc., that go, you can take full advantage of that difference by investing it yourself, that difference in the market, and recouping or enjoying the benefits yourself fully without having somebody else do it for you and then collecting a lot of commission out of that. So yes, you can do it yourself. So that's how a lot of people will say you handle it. The problem is that a lot of people don't have enough confidence in the financial markets to do it themselves, and that's a pretty expensive way to have insurance companies invest your money for you because you're paying a lot in commission and so on and so forth. So yes. Is there a type of viatical insurance that is applied to businesses that are tanking or going bankrupt? Not that I know of. Viatical insurance is really for personal, policies with terminal diseases and things like that. So it's not. Corporations are not. Corporations have enough ways to deal with things financially. With term insurance, what happens if you are young but are diagnosed with a terminal illness like cancer? So as long as the policy is active, they have to pay within, but if you want to renew the policy, and unless you have a guaranteed renewal contract, then they can cancel you at that point or put that as an exclusion criteria, which means that you're not going to be paid anymore for that same condition. So that's why when you get insurance policies, it's always good to have one which says guaranteed renewable policy, because those are the ones where you can continue on under the continuity rule, and if you get stuck with something serious, you would get covered, assuming there's no other conditions that you're violating and stuff, because this is a legal contract and they're going to try to find every which way to deny you money. But for the most part, don't you have to pay more for life insurance if you participate in a lot of risky activities or even do things like smoke cigarettes? Yes. Don't we have that thing coming up? Yeah. So yes, you'll see how smoking affects your rates very soon. We have that. If a job offers us life insurance, is that good enough, or should you get more? More in what? I mean, are they just giving you only life insurance and nothing else? Then, yeah. I'm not quite sure I understood that question, so if you could explain that to me, I'll take a stab at it. If insurance companies make more money from the public than paying off bills, why do we pay for insurance if there is a net loss of money from the public? I didn't quite understand that question. If you were hit with a big... so here's why you take it. Yes, insurance companies are making money. That's a fact. If you look at the balance sheets, insurance companies and oil companies are two most profitable sectors in this country. Okay, so that's without any doubt. Just the balance sheets will tell you that. But more importantly, you're not buying insurance to help or hurt the insurance company. You're doing it for you, right? Whether the insurance company makes a ton of money, yeah, that's a good thing or a bad thing, whatever, depending on your perspective. But ultimately, we are all buying insurance contracts not to worry about what it's going to do to net money in and out of the. That's not our concern. Our concern is that if we have a problem, a health problem down the road, and if we don't have insurance, probably we won't be able to afford most of the things that we'll need because of the huge cost of healthcare in this country. And so you buy health insurance, you do what you need to make sure that you and your family are protected. That's why you're buying insurance, not to worry so much about what it's going to do to net money in society and insurance companies and so on and so forth. We are doing it primarily to lay off risk ourselves. Insurance companies are in the business of doing that for us in lieu of money, and that's how the system works. All right, now let's move on. All right, perverse incentives. So this is something that needs to be discussed. So what does perverse incentives mean? So it's an economic term that really means that in trying to do something good, something unexpectedly bad happens that we did not plan for. So that's where the perverse part comes in. So you want to incentivize something because that makes sense at first blush, but then it then gets used and distorted in a way that was not the purpose of the original regulation. So here's an example. If welfare payments are based on the number of children one has, which kind of makes sense because if you have more children, that means there's more money that is needed for their care, then you want to make sure that people don't get hurt for having bigger families. But there's an incentive that's also created in the process to have bigger families because that means getting more money. And so a lot of people end up having larger families just to get more money. That's a perverse incentive because the law was not created to encourage people to have more children, but the law was created to make sure that large families got appropriately taken care of. So it's sort of the argument gets turned on its head, and so that's a perverse incentive. And so a lot of times when you're a regulator or passing laws or designing regulation, you have to worry about these things, that something that seems useful on the surface may then be twisted and misused in a way that can hurt rather than help, or hurt in other ways that you did not intend. So another example is the bank sets a loan officer's a bank sets a loan officer's annual salary and bonuses based on the number of successful loans he or she processes. Number. If it's a raw number counting, and as a loan officer, if you close 500 loans versus 200 loans, you get so much more money, then your incentive is to make close as many loans as you can. And in fact, that is the reason why subprime, the crisis we had a few years ago happened was because banks were, the loan officers, people making these loans were so intent in closing deals that they manufactured in most cases, like Countrywide Financial, a lot of people went to jail over this or were fined or went out of business because loan officers working for those outfits were in most cases manufacturing the financial records of potential customers to make them look better than what they were so as to be able to close the loan. And so for loan officers, the incentive was to close the loan, collect their bonuses and all that, whereas, and we know what happened there. When too many people were doing this thing, the whole system collapsed. So how does it relate to insurance, you may be asking yourself? And the answer is that as we transfer risk, so once we transfer risk to the insurance company, we then develop an incentive to maybe engage in risky behavior because it's not our problem anymore, right? So a good example is going skydiving. So I mean, you can indulge if you have health insurance and all that. Well, if you go skydiving, now that's hitting close to home, but some might argue that you're taking chances. You're indulging in silly risk-taking behavior that can cause you harm. But more importantly, so for example, you can let's say you have car insurance, auto insurance, and you have decent coverage. It may give you, or you may have a perverse incentive to not take good care of your car, because you know that if something bad happens, well, it'll be taken care of. And so that's a perverse incentive, and insurance companies, so this is called moral hazard. Okay, it's called moral hazard. This idea of moral hazard is basically exactly this, that you, hidden action, right? You take action unbeknownst to the insurance company that increases the likelihood of an adverse event, or increases the likelihood of a higher than normal damage to the asset that the insurance company cannot prove, but they suspect that you did. So for example, you go to a busy city and you park in a shady neighborhood, you don't take care of the car, you come back and lo and behold the car is minus 4 wheels and certain things in the car are missing. Well, then you file for insurance, right? And so those kind of irresponsible behavior increases insurance cost, and insurance companies are very concerned about that. It's a moral hazard. And so insurance companies have a way to get back at it, so to lower your enthusiasm for such behavior. And so we'll talk about that. One way is that they will make you pay for part of the loss yourself. That's a good way for insurance companies to ensure, or try and ensure, that you behave responsibly, because they force you to pay for some of the damage yourself, right? So if you have an insurance policy with a $1,000 deductible, for example, well, $1,000 deductible means that any loss, the first $1,000 is yours. The insurance company doesn't even come into the picture till that $1,000 threshold is crossed. That means that if you do something, it's going to give you pause. The idea in theory is that if you have a deductible, then that's going to impact your behavior in a positive way, because you know that if something bad, you do something negligent and something bad happens, then the first cost is yours. The first dollar loss is coming out of your own pocket, and that can ideas that will make you more responsible in your risk-taking activities. So, is there a more concrete definition of risky behavior, or is it up to the insurance agency and the underwriters? So the insurance agency and underwriters are not really defining the risk per se. The risk is the risk. We all know what those risks are. You can lose you can have an accident if it's a car. Those are already known. Those insurance companies don't define that. What insurance companies do is they define your risk. How much risk are you responsible for because of your age, where you live, what kind of activities you do, what kind of a student you are in school? Those are the kind of things that they use to define you as a risk element. And so if you fall in the low risk category, let's say you're a great student, you got straight A's, you've got defensive driver courses, you've never got in trouble, those kind of things put you in the low risk category. If you don't have those features, then it puts you in a higher risk category. So those are the kind of things that insurance companies do. They are not dictating anything else. The risk is the risk. The insurance companies don't define risk. They define you and put you in different boxes. That's their job. Because if they don't do that properly, then they're going to lose money. Think about it. If you happen to be a risk-taking person, and they mistakenly classify you as a low-risk person, think about it. Then they're going to charge you less in premium. You're, of course, a high-risk person. You're going to have high losses because of who you are as a person. That means the insurance company pays a lot of money to cover you, and they don't get a lot from you in terms of premiums because they misclassified you. So misclassification is extremely costly for insurance companies, and that's why they spend millions of dollars, and many statisticians and actuaries, insurance actuaries, to try to pin down your risk, who you are in the risk category as accurately as they can. This is a huge business. That's why Purdue has an actuarial science. And that's one of the big things is you have to be well versed in statistical analysis in order to be able to work for insurance companies where this is what you do. You develop better and better models to predict risk of people.